I think it's a matter of time gold gets to $3,000 an ounce. It could meet the S&P 500 at that same level. It always has gone back to 1-to-1. And it's probably going to have some back and fill. I don't know how much lower it goes, but 2,200 is pretty good support. But the significance is gold has had a history of rallying when Treasury bond prices are rallying, meaning yields. So in terms of dollars. Now, if you're in a country that's debasing your currency, sure, gold's always going to be about currency debasement hedging. Gold has one key difference, is it is a store of value. And it's been breaking up for a while, and the deepest pockets on the planet are buying gold. Also, what just happened recently is that we've had a 2-year downtrend in ETF flows. It's just starting to turn upward. So one thing that's holding gold back right now, it's pressuring it right now, is managed money futures positions are pretty stretched long for a bull market. That's a key thing now. If you overlay like a 200-day moving average of gold, Bitcoin, and the S&P 500, they're all heading straight up. And one of them's going to, I think only one's going to win out of that. And I fully expect 200-day moving average to tilt lower and Bitcoin to tilt lower and S&P 500 as they tilt lower. But gold has one key difference, is it is a store of value. And it's been breaking up for a while, and the deepest pockets on the planet are buying gold. Also, what just happened recently is that we've had a 2-year downtrend in ETF flows. It's just starting to turn upward. So one thing that's holding gold back right now, it's pressuring it right now, is managed money futures positions are pretty stretched long for a bull market. They're getting stopped out. It's one of those environments. It's not a want to sell. It's a got to sell. You sell what you can. And that's happening in gold and Bitcoin. But gold's going to come out of this ahead because as a percentage of compared to ETFs, are much more significant than futures were back in 2008 when gold went to 1,000. It dropped to 700, and then it started to move all the way up to 1,900. So I think this is a normal reaction. But the bigger picture problem is beta.
There's talk that Mike McGlone believes the U.S. stock market, especially the S&P 500, is long overdue for a bear market, or at least a normal correction. People are saying, buy the dip, but according to McGlone, the market hasn't even touched its 200-day moving average yet. He points out that just a few weeks ago, it was the furthest above its 100-day moving average in almost 2 decades, aside from the massive money influx from COVID relief. He seems to think a normal reversion is on the horizon, and commodities are hinting at this. Word is that McGlone also mentioned the Bloomberg Industrial Metals Spot Index, which peaked earlier this year with a 24% rise, but then fell for the year just a few weeks ago, suggesting something might be amiss. He's reportedly saying it's only a matter of time before gold hits $3,000 an ounce, possibly even matching the S&P 500 at that level, which historically has often returned to a 1-to-1 ratio. While he's not certain how much lower gold could go, $2,200 seems like solid support in his view. They say McGlone emphasizes that gold tends to rally when Treasury bond prices rise, as yields fall. He apparently believes that for those in countries with depreciating currencies, gold will always act as a hedge against currency debasement. Word is, he's predicting that gold and US Treasury long bonds will be the best performing asset classes over the next few years as we head toward a global recession, which he thinks is on the horizon. McGlone has supposedly pointed out that the average yield of the top 5 countries globally, excluding the US and including India, recently reached 100 basis points below US Treasuries. Normally, US Treasuries yield much less than the rest of the world, but now they're catching up. Despite concerns about deficit spending, he still sees Treasuries as the place to be. According to him, deflation and inflation are key, with commodities, especially industrial metals, showing clear signs of deflationary forces. Some say he's also mentioned that any backup in beta is just normal deflation, following the significant inflation that came after the biggest money pump in history, leading to the peak in 2022.
It's not so much what's driving the panic. This is normal mean reversion at the moment. The S&P 500 at about, as we speak, 5,200 is well above its 200-day moving average at 5,000. There's still a lot of room for it to just catch up. It's just an example of what typically happens in markets is the most powerful force is mean reversion. Markets just got way too expensive. Then we saw kind of the plunge in the yen carry trade, the give back of all that liquidity there. But I think, to me, the best leading indicators for all this has been Bitcoin. It trades 24/7. It's massive speculation. It has very high volatility. It started breaking down on Saturday, then Sunday. It should have told you what's going on. But to me, this is just the beginning of a normal market correction. And when you hear everybody say buy the dip with the S&P 500 still well above its 200-day moving average, ignore them and let markets work. But we might have some short-term bounces. In fact, we should. The Fed is going to ease. I mean, they are way above the rates of inflation in this country. But to me, it's the macros I pointed out earlier. We have just a long-term example of risk assets getting way too expensive. Cryptos were a good example of that. I think gold's going to come out ahead. Now, it's getting a little bit hit today, but it did begin in 2008. But there's some key differences that I think are more supportive for gold this time than last time. Market pumped up to the peak in 2022 and then fell to where it is now. It was a commodity market. Now we're switching back to a market of individual commodities. And crude oil was a great example. What drives these futures markets are speculative futures. Managed money net positions in futures are good indicators. So petroleum futures got way too long at that peak early in the year in the 80s, and then got sold out completely as we flushed down to 69 or so in WTI. So they're basically sold out. So crude oil is basically somewhat flat in terms of managed money net positions. But what the key thing was this year was copper. That copper high, $5.20, was almost completely driven by pretty significant, massive buying in speculative futures.
There's talk that Mike McGlone sees managed money net positions in futures as a key indicator. He said to believe that petroleum futures got way too long earlier this year, hitting their peak in the 80s before getting completely sold out as WTI dropped to around $69. Word is that crude oil is now somewhat flat in terms of managed money net positions. But what really stood out this year, according to McGlone, was copper. The copper price reaching $520 was reportedly driven almost entirely by massive speculative buying in futures, with open interest at the CME hitting its highest level in about 4 or 5 years, surpassing 32%. Rumor has it that these positions are still getting flushed out, but the problem seems to be that copper usually bottoms out when these positions drop to more normal or lower levels. This pattern appears to be happening across all industrial metals, with copper being the most significant example. All of this is happening while the yield curve is flattening and beginning to signal a recession, which McGlone reportedly sees as a clear sign of deflationary forces in the market. Finally, it's said that McGlone pointed out that the Bloomberg Commodity Spot Index is down 1.4% for the year as of the end of last week, marking its worst start to a year in about 2 decades. He supposedly believes that these are signs of market normalization, which is typical during corrections as the most expensive assets revert to more normal valuations. In this environment, McGlone is said to expect gold to rise in value, with long-term support around $2,200 and potentially surpass $3,000 as the market adjusts to global economic uncertainty.